Welcome to this explainer. Today, we're cracking open the door to the financial engine room of the Maldives Monetary Authority. We're going to unpack the whole shebang of their liquidity management framework. We'll be looking closely at the daily dials they turn, the structural levers they pull, and the sweeping long-term upgrades they're putting in place to keep the national economic engine humming along perfectly. So, who actually controls the daily flow of money in an entire country? I mean, think about it. Ensuring there is exactly the right amount of cash moving through the banking sector is literally a high-stakes balancing act. If there's too much, boom, you risk inflation. Too little, the gears of the whole economy just grind to a halt. Okay, let's dive into this and see exactly how a central bank manages the hidden plumbing of the financial system.
Part 1. Balancing the daily books.
So after the central bank runs its auctions earlier in the day, they don't just clock out. They execute a really rigorous end-of-day review process. First up, they monitor intraday payments and interbank flows. It's basically like checking the real-time blood pressure of the entire banking system. Then they take the actual liquidity numbers and compare them against what they forecast would happen. Finally, they tweak and update their models based on cold, hard reality. And here's the wild part. If those actual numbers diverge too much from the forecast, the MMA might actually jump back in and conduct a fine-tuning operation later in the day. They do whatever it takes to keep everything perfectly balanced before the banks close their books for the night.
But, what happens when the system is consistently off balance? Well, when the central bank reviews structural liquidity on a quarterly or annual basis, they are hunting for persistent trends, like maybe average excess reserves or unusually weak interbank activity. And this brilliantly illustrates the exact structural policy levers the MMA pulls. Say there's a persistent surplus, meaning way too much cash is just sloshing around. To fix that, they can raise reserve requirements or increase the volume of their open market operations. On the flip side, if there's a persistent shortage, they pull a totally different set of levers. They might lower those reserve requirements, or they might expand the eligible collateral for repos, which basically makes it easier for banks to get their hands on cash. It is a constant, ongoing calibration of the system's baseline temperature.
Section 2. Inside the control room. Now, zooming out from those daily metrics, decision-making here is perfectly hierarchical. It's split across a crew of 3 distinct entities. At the very top, you've got the Monetary Policy Committee, or the MPC. These are your big-picture thinkers. They set the broad stance, deciding whether policy should be tight, neutral, or easy, and they approve any major changes to the reserve framework. Next up is the Liquidity Management Committee, the LMC. Think of them as the tactical daily operators. They're meeting daily or at least weekly to review those forecasts we just talked about, and they decide the actual operation volumes, all within the boundaries set by the MPC, of course. And finally, rounding out the crew is the Risk and Collateral Unit. They work continuously to keep the whole system safe. They determine what counts as eligible collateral, set haircuts, and manage counterparty limits. Honestly, it's a brilliant separation of strategy, tactics, and risk management.
Moving right along to Section 3, coordinating the cash flow.
Okay, so the MMA control room doesn't operate in a vacuum, right? To steer the national economy effectively, the central bank absolutely must sync up as co-pilots with the Ministry of Finance. See, government spending and taxation cause massive swings in the amount of money floating around the banking system. To prevent those swings from causing total chaos, the Ministry of Finance shares these weekly and monthly cash flow forecasts. We're talking about anticipating exactly when taxes are collected, when thousands of public salaries hit bank accounts, and when major debt payments are due. On top of that, they hold a joint quarterly meeting just to align the issuance of treasury bills with the MMA's own operations. Anticipating these huge cash flows is exactly what keeps the financial ship steering perfectly straight. A crucial tool in all that coordination is something called the Treasury Single Account, or TSA. Basically, it's a system to consolidate government balances. And why does this matter? Well, think about it. Instead of having government cash just hidden away, sitting idle in dozens of different pockets across various banks, it's all consolidated into one spot. This vastly improves visibility. The MMA can take this highly accurate TSA data and plug it directly into their daily liquidity forecasts to maximize the efficiency of the entire banking system.
But hey, coordination isn't just an internal thing. External market communication is absolutely vital. The MMA publishes regular reports summarizing their operations and the overall liquidity conditions. They also provide really clear explanations of their policy rate decisions and how those specifically tie into the country's exchange rate peg. By putting out pre-announced auction calendars and setting crystal clear eligibility rules for repos, they help maintain market stability. Basically, when the market knows exactly what the central bank is doing and why they're doing it, panic is completely removed from the equation. Which brings us to the next section. Let's move to and see how this builds into the three-phase roadmap.
So, the Maldives is currently executing this massive, ambitious implementation roadmap to upgrade their system, and it's broken down into three distinct phases. Phase 1 is the immediate short term, happening over the first 6 months. Then, Phase 2 is your medium term build out, spanning from month 6 to the 2-year mark. And finally, Phase 3 is the long term strategic evolution, looking out about 2 to 5 years. Let's break down exactly what happens in each of these critical phases. Phase 1 is all about getting the house in order. Stabilize and formalize. Over these initial 6 months, the main priority is just internally documenting and approving the framework. It's about actually getting that daily forecasting process up and running and officially forming the Liquidity Management Committee we talked about earlier. They also standardize the rules for MMA bill auctions and kickstart that vital, regular data sharing with the Ministry of Finance. It's really the fundamental groundwork you absolutely need for a modern central banking operation. Right, so once that foundation is stable, we move into phase 2, which is all about deepening the financial instruments they have available. Over the next 6 to 24 months, the MMA will introduce and expand their repo markets using standardized contracts. They're going to gradually start lengthening the tenors, which is just a fancy way of saying the lifespans of MMA bills, and they'll actively encourage secondary trading among the banks. They'll also refine their reserve requirements so they're differentiated by maturity and tightly improve coordination between their foreign exchange and liquidity desks. Essentially, they are handing the banking sector much more sophisticated tools to manage their own money.
And finally, we reach phase 3, strengthening resilience. Looking out 2 to 5 years, the goals here become highly advanced. Step 1 is developing reference money market rates, like a reliable overnight or 1-week rate. Step 2 is incredibly important, enhancing the macro-prudential toolkit to specifically complement and compensate for what has historically been a pretty weak interest rate channel in the Maldives. And step 3? That involves building complex, integrated stress testing frameworks that combine liquidity, foreign exchange, and credit risks all into one comprehensive model. Ultimately, this phase is all about bulletproofing the economy against major external shocks.
So this brings us to a pretty crucial question. How might moving toward a more explicit monetary policy framework change a country's economic standing on the global stage? The ultimate goal of this entire 3-phase roadmap is to push the Maldives toward greater transparency, eventually establishing a much more explicit monetary policy framework, maybe even a stated inflation objective that lines up with their exchange rate peg. You see, upgrading from basic cash management to a highly sophisticated, transparent framework doesn't just stabilize local banks, it literally signals maturity to the entire global financial system. It changes how international investors, trading partners, and global institutions view a nation's economic resilience. It is a fascinating evolution, and frankly, an incredible piece of machinery operating just beneath the surface of the economy.